guest tonight is amongst the most knowledgeable people I know about mortgages in terms of both breadth and depth, Laurie Goodman. Laurie had a distinguished, if not to say legendary, career on Wall Street for a number of years before she moved on to run the mortgage research project at the Urban Institute. That group puts out a mortgage dashboard on a regular basis that is one of the most useful sources of information I know. You have seen links to the dashboard in class so far this year. And so, Laurie, it's a great pleasure to have you with us today.
Well, thanks very much for inviting me. It's a pleasure to be here.
So, as I informed Laurie, I start by asking all our guests to talk a little bit about their career and how they got to where they are at the moment. So, Laurie, you're going to be no exception. Please tell us how you have arrived where you are in life at the moment.
Well, I got my PhD at Stanford, actually, and wasn't sure whether I wanted to teach or do something on the business side. So the academic job market happened earlier. I took a job as an academic, and it just wasn't me. One big difference between being an academic and being in private industry is that in academia, you spend a lot of time making sure everything is perfect. In private industry, you spend 90, if you can get 90% of your time, 90% of the way there and 10% of the time, that's a really good trade-off. And I decided that being an academic wasn't for me. I moved to the Federal Reserve Bank in New York, and I was there about 4 years. And then I moved on to Wall Street, basically first doing research on futures and options, and then from like 1989 on doing research on the mortgage market. And that was truly my passion. It was really, I went through a lot of very interesting cycles in the mortgage market and just sort of loved researching mortgages, on helping investors figure out what they were supposed to do with their money, what represented the best relative value, what policy was going to be, and how that influenced the value of the mortgages. I made a lot of impact going through the great financial crisis. And then sort of around 2012, 2013 began to feel like, oh my God, what does someone do who's too old to work the kind of hours you have to work on Wall Street, but too young to retire? So my second career was moving to the Urban Institute to found the Housing Finance Policy Center, which is essentially dedicated to providing data-driven analysis of public policy issues. Sort of during my time on Wall Street, I found that people just didn't have data to make good decisions. And the hope was that in founding this center, we would be able to provide good data that underlie decisions. I mean, sort of everyone's entitled to their own opinion, but they're not entitled to their own facts.
I used that quote about 90 minutes ago. So, Keynes keeps coming back at us over and over and over again. This is a total sidebar, but I was reading a paper on the returns to real estate for investments at 4 colleges in Oxbridge, going back to 1900. And Keynes ran investment for King's College from 1925 to 1946, which is when he died. And the finding of the paper is that real estate returns to those colleges were actually quite disappointing. The interesting thing about Keynes is he reduced King's holdings of real estate as a share of the portfolio by about 2/3 over the time of his management there. So he knew what he was doing in so many dimensions. It's kind of remarkable. So Laurie, I was going to move on to talk about the Housing Finance Policy Center, and I'm going to get to that in a second, but you said something that really intrigued me, which is about finding value in mortgages. And that's a lot about what this class is all about. So I want to back up a little bit to your previous career and ask you, how would you go about doing that? How would you determine when it was a good time to buy a mortgage-backed security and when you wanted to get out?
So yeah, it was basically a combination of sort of looking at at where we were historically, and then also looking at what could happen going forward. And generally, the time that everyone was most in love with any given asset class was sort of generally the worst time to buy. because people were piling in at the peak and sort of taking underloved asset classes and trying to figure out if there was something really bad about, whether there was something inherently bad about them, or whether they were just unloved because they had just gotten really, really hammered. So I don't know if a couple of specific examples would be useful to you.
Yes, please, please.
But I sort of remember, after the 2008 financial crisis, as bad as Fannie and Freddie securities performed, private label securities did an order of magnitude worse. I mean, nobody would buy these securities. And the way they started structuring the securities changed, the structuring pricing speed changed. So one of the complaints about the securities is, I just have too much extension risk on the securities. So even if you tell me they're credit good, which I'm not sure I believe, I'm really worried about the credit risk component. Well, we went back and because the securities were structured differently, the extension risk was just much, much less. And so we were able to show that to some investors, and it turned out to be one of the home run trades.
But talk a little bit more specifically about why the extension risk, what it was about the structuring that made extension risk less of a problem.
So basically, they slowed down the pricing speed. So sort of at the peak, just prior to the financial crisis, some of these non-agency jumbo securities were priced at pricing speeds at like 525 or just 525 PSA, just really, really fast. So if you go from 525 and then you slow it down to 200, it's tremendous extension risk. Whereas if you start pricing at 250 and you slow it down to 200, that's much less of an effect. So the extension risk was just an order of magnitude lower, which basically meant that the shorter classes were just a lot smaller as well. So you were better protected in all respects. And actually, interestingly enough, sort of in the wake of COVID-19, sort of a similar thing happened. Although it wasn't the pricing speeds. People became so concerned about when the Fed intervened and basically, propped up the agency market. Nobody propped up the non-agency market. Meanwhile, some of the mortgage REITs who had a lot of non-agency loans and a lot of non-agency securities were forced sellers because they were leveraged entities and the values of the securities went down, which meant they had to sell to keep up with their margin calls, which meant the prices went down more because nobody was buying because no one had any excess funds. And so it was just a purely liquidity crisis, and the values of the non-agency securities and loans just absolutely plummeted. I think the worst pricing was sort of late March, early April. And then, sort of the forced sellers were sort of recovered or received forbearance. And at that point, prices began to improve and have in fact improved dramatically since then. But if you had looked at this sort of asset class and said, oh my God, it's bad, nobody wants to buy it, you would have missed just a fabulous opportunity to purchase, assuming that you had the funds to do so, because people were the prices just plummeted to the extent that you could assume really, really worst case scenarios in terms of how many borrowers were going to default on legacy or how bad forbearance was going to get on new securities and not break these securities and still end up with a very healthy return.
Yeah, I was talking to our friend Chris Mayer about mortgage REITs and how, the value of them just collapsed. And it didn't make sense to me because if you look at how the private label stuff has been underwritten over the last 10 years, it's been so tightly underwritten. It's just hard to see a lot of danger there. And the legacy stuff was all originated at most recently 13 years ago, which means any problems that would have had would have been long gone. So that was really a mystery to me. And so
it's too bad you weren't managing a portfolio to take advantage of it and also introduce some amount of rationality into the market.
Yeah. So and that's really interesting. So, but those sort of opportunities are exactly, I think, what students want to hear about. I tell them about Scott Simon's PIMCO trade, where he decided to go very long on Fannie and Freddie securities in 2008 on the grounds that it was very unlikely that the government was going to let them fail. And at the same time, the prepayment there, the extension was good because there was no credit risk. So the prepayment slowed down a lot until, HARP came along, which we're going to talk about a little later. And so you had all these mortgages trading at a premium that weren't going to default. And so that was a really good opportunity at the time. But let me come back now to what you're up to now, which is the Housing Finance Policy Center. So just tell us a little bit of what's it about? And you talked sort of broadly about the idea is to provide good data to people making decisions about mortgages. But I think that doesn't do justice to it. Talk a little bit about the sort of projects that you have been working on since you've been running the center.
So I think our biggest focus has actually been credit availability. The credit box got very, very tight in the aftermath of the great financial crisis. That is, it was very hard for borrowers who didn't have pristine credit to get a mortgage. And people started talking about, we only want to make sustainable mortgages. We only want to make good mortgages. Well, if you can tell me what a good mortgage is, you're a better person than I. It seems like every mortgage has some probability of default. There are very few mortgages where there are very few borrowers will never default. There are very few borrowers that will always default. It's not about making sustainable mortgages. It's about figuring out what probability of default you're prepared to tolerate. And, so the credit box tightened to the fact that to the point where we were prepared to tolerate a fairly low probability of default. It's been sort of slowly, expanding until COVID-19, at which point it's tightened considerably, but, sort of nothing, but still you're still at the peak, you're, still in, sort of early 2020, you were taking less than half the credit risk you were taking in sort of 2001, 2002, a period of what I would consider normal credit standards.
So that gets into your million missing mortgages, which is a very nice, catchy way to put things. Tell us a little bit about how you went about finding, if that's the right word, those million missing mortgages and the implications of that.
So we actually did that work a while ago, and it was sort of a pain. What we went back and said, okay.
Well, the best work is a pain.
Yes, but you've got more patience for it than I do. Hence my short academic career. But basically what we did is we went back to a time when what we did is we looked at sort of what the credit box looked like in terms of loan to value ratios and FICO scores during sort of periods where during a period where we thought credit was sort of normal, and then we looked at what it was at any given point in time. So I think we first did this analysis in 2014 when credit was like nearly at its tightest level, and we said, okay, so how many mortgages, what percentage of mortgages were in this category, this category, this category? We assumed the top category, basically all the mortgages to high FICO, low LTV borrowers were getting made. And actually we did it primarily by FICO. And then whereas by the time you got to the bottom category, there were much lower portion were made. So we said, okay, let's say the top category was constant. All those mortgages are being made. If we were to go back to the credit condition, if we were to go back to earlier credit conditions, how many loans are missing from the intermediate and bottom categories in terms of FICO scores? And then we made some other adjustments, but that was basically what we did.
So the other way you characterize this is you talk about a product risk and borrower risk, and you do a
yes. Housing credit availability index.
Yeah. So tell us a little bit about that, and what I will do is put a link to show people the picture to accompany.
Yeah. So what we did is this goes back to what probability of default are we prepared to tolerate? Because I think this is just absolutely critical. So basically what we did is this was actually methodologically fairly straightforward. What we did is we did two giant lookup tables, one for 2001, 2002 mortgages, one for 2005, 2006 mortgages by debt to income ratio, loan to value ratio, FICO score, and whether or not the loan is a risky product. That is, whether it has a short, whether, the payment jumps dramatically, or there are heavy prepay penalties, or it's negative amortization. And so we did two lookup tables, one for sort of traditional products and then one for non-traditional products with sort of risky features. And then for each of the giant lookup tables, we looked at historical performance of the 2001-2002 data, the historical performance of the 2005-2006 data, weighted the 2001-2002 data as a 90% probability, the 2005-2006 data as a 10% probability, and came up with what we call the ex-ante probability of default for mortgages in any given origination quarter. So for each quarter of mortgage production, we mapped it into essentially our four lookup tables: 2001, 2002 traditional products, risky products; 2005, 2006 traditional products, risky products, and then mapped in the probability of default. And then we said, okay, let's say we didn't have any of these risky products, we only had traditional products, and that differential was essentially our product risk differential. And what it does is, so in 2001, 2002, the ex-ante probability of default was something like 12%. It went up to about 17% in 2006, 2007, and it's now well less than 6%. And if you look at the product risk, you find that almost all the increase from 2001, 2002 to 2006, 2007 was product risk. That is, borrower characteristics didn't really change that much. It's just that you introduced risky products, and those risky products had a much higher probability of default. And then now there's almost no product risk in the market left.
Right. And so let's remind our students, what are risky products? What are some examples?
Products are sort of subprime mortgages where the payment is fixed for 2 or 3 years and then jumps dramatically. It's negative amortization products where essentially you pay less than the interest rate on the mortgage, so your principal actually grows the first few years. It's interest-only mortgages where you don't pay down any of the principal. It's mortgages with hefty prepay penalties where essentially once you get in, you can't get out. So it's basically the grab bag of products that have what I'll call non-traditional features.
So do you think these products, so let's talk about like a negative AM product. Do you think that's ever an appropriate product for a borrower to take on?
Their answer is there are some subset of borrowers for whom it is appropriate, but it is a very, very small subset. And so I'm not sure that it should be ever a standardized product sold in the capital markets. But if a bank wants to make a loan to a guy who's just finished medical school, who's just finished his internship, who's about to start practice, who's just signed something, who's expecting to make a lot of money very quickly, but right now doesn't have a whole lot. There are some sorts of circumstances in which it's appropriate, but it's very, very rare. For that product, you'd have to know for certain that person has a fast-growing source of income, for instance.
Yeah, it's like, we're in a different world. 30 years ago, we used to talk about these things because we thought that we were in an inflationary environment. And so tilt was a big problem, because if everybody's income was going to go up by 5% a year in nominal terms, and you were paying a real interest rate of 3%, but that meant that it was 8%. It meant that people who actually knew could afford a house couldn't afford the house because the DTI was too high at the beginning of the loan. But now we're in a world of basically no inflation, and so those products are less sensible.
Yes, you have to assume that the income is going to rise very, very quickly. And so if you said to me, are there a large enough group of borrowers for whom this makes sense? The answer is probably not, but it could be a niche product, but it's sort of a product that should be in a bank's own portfolio where they eat their own cooking.
Right. Well, and so that gets to, that was a prelude to the next question, is what do you think about the impact of Dodd-Frank on the mortgage market? on the whole has been a positive, a negative, neutral? Did they get it more or less right? Did they go too far? Did they not go far enough?
I think Dodd-Frank itself has been a huge help. I think the qualified mortgage rule, which basically says, hey, you can't make these non-traditional products that haven't be a qualified mortgage, was a tremendous help. Not because it banned the products to begin with, because the market had already done that. The market had already taken action and said, we're not going to buy these products. Right now, we just don't, we're just not sure enough about, given all that's happened, we're just scared to buy these products. But what it did is it forestalled a re-rise of these products, and it just made it much more made it less economic for banks to offer these products to their borrowers because then they've got the liability risk associated with it. The fact that the borrower said, "Oh, you said that," the borrower could come back and sue.
Some of us think, and I'd be curious about it. I shouldn't say some of us. I think that once you get rid of the toxic products, and I'll call them toxic, non-traditional, the need for consumer protection beyond that is pretty small, and you should allow people to be making decisions. And so once you've gotten rid of the complicated, exotic, toxic, whatever you want to call them, products, you should allow lenders and borrowers to come to an agreement about what's appropriate underwriting on a loan. And when you impose anything on top of that, I think that may be a step too far in consumer protection.
I would agree with you. I think you got to make sure that the borrower fully understands what the loan they're taking out. But if that happens,
well, that's the beautiful thing about a fixed rate self-amortizing mortgage is what your payment is going to be for the life of the mortgage. It's a pretty straightforward product. Right.
I agree with that. And so once you've gotten rid of the non-traditional products, I agree. There's very little need for consumer protection. I mean, you do want to make sure that the borrower. One additional restriction, which was not part of Dodd-Frank, but in implementing Dodd-Frank, the Consumer Financial Protection Bureau decided that there should be a hard 43 debt-to-income limit on mortgages, which is a rule that I know never made any sense to either one of us, because it's like, why would you do that? That's really stupid, because if you can do an over 43 debt-to-income mortgage with a lower probability of default, why wouldn't you make that mortgage instead? The CFPB is looks like it's finally going to get rid of that 43 debt-to-income rule. Unfortunately, that rule wasn't as detrimental as it could have been, because they basically said, "Oh, GSE mortgages aren't subject to this rule because of something called the GSE patch." They're proposing to essentially get rid of the 43 DTI and get rid of the patch. So it puts private label, puts mortgages inside conventional mortgages underwritten by the GSEs and not underwritten by the GSEs on the same footing. That is, private label loans and loans in bank portfolio are now would be on the same footing as GSE loans.
So let's now come to where we are right now, mortgage market in a time of COVID. How have you seen COVID influence the market? Do you think it's working well? Do you think it's working badly? Do you think in some ways it's working well, in some ways it's working badly?
So, choice C. So here's what's working well about the mortgage market. So first of all, homeowners were less impacted than the population as a whole. They're by and large more affluent. The toll on the sort of renters have been far more impacted by layoffs than homeowners. Homeowners are far less apt to be in the most vulnerable industries. In general, homeowners are less impacted by unemployment. The homeowner unemployment rate is only about 80% of the national average historically anyway. Then the GSEs and FHA, and then Congress moved very, very quickly with forbearance, which basically allowed borrowers who are in trouble to essentially defer payments on their mortgage, which has been very powerful. I think the original thought was 25% of the borrowers would take advantage of it. The actual number has been more like 7 to 8%. But certainly, that has provided a very important outlet, and the fact that everyone moves so quickly is very, very positive.
Laurie, I find it interesting that even of those 7 and 8%, a bunch of those people are still making their monthly payment.
Yes, about 25% of those are still paying.
Yeah. So I'm sorry to interrupt, but I thought it was worth getting that little detail in there.
You. And then purchase application, and then because the Fed has eased so dramatically, and interest rates are at their lowest level ever, you've had a huge increase in the number of people looking to buy their home, including first-time home buyers. So the MBA purchase application index is actually higher than it has been in previous years at the same time. Home prices continue to rise. So that's all working really, really well. And of course, home prices haven't risen as quickly as interest rates have fallen, so more people can afford to buy. Debt to income ratios have come down. That said, here's what's not working. The credit box has tightened dramatically. It's much harder, if you've got a sort of middling credit score, it's much harder to get a mortgage than it was before.
And it was already hard to do it.
It's already hard, but it's gotten much harder, and it's also hard to refinance your mortgage. So if you already have a mortgage with Fannie and Freddie, why it should be hard at all, why you shouldn't be able to get a lower rate on that mortgage is beyond me. The GSEs already have the risk on your mortgage. Why wouldn't they give you a lower rate and reduce their risk? So so I think the tightening of the credit box has been very dramatic. It impacts minority borrowers, Black and Hispanic borrowers more than it impacts white borrowers, because by and large, Black and Hispanic borrowers tend to have lower credit scores and the biggest and higher debt to income ratios. And the tightening has essentially been especially in the credit score dimension, but to a lesser extent in the debt to income dimension.
So let's talk about, so I want to pivot a little bit based on that last sentence, because I know your center's also been doing a lot of work on the Black-white homeownership gap, and it's a very frustrating thing to look at. The gap, I believe now, is every bit as big as it was, maybe even bigger when the Fair Housing Act was passed in 1968. If you have any thoughts about things we might do to ameliorate this?
Yeah, I mean, it's a very, very difficult issue, but yes, you're right. The gap is every bit as large, if not larger. I think there's a number of things that can be done to ameliorate it. We actually have a very, very narrow view of credit. We use the credit score from the credit bureaus. Well, guess what? So,
which is now a 20 or 25-year-old algorithm, something like that. By the way.
Yes, and that's exactly right. So right now, the version that's being used for mortgages is the version that was designed in the late 90s. So student loan debt isn't. There's only one kind of student loan debt. There's no differentiation there. Medical debt has been shown to be extremely unpredictable. That's still in those models. There have been a lot of advances in the credit scoring models, none of which are incorporated into the mortgage process. Although Fannie and Freddie have taken some steps on their own to do so, but not as much as they could. But what the biggest thing that's missing from credit scores is actually, you think, well, gee, what should be more predictive of my ability to pay a mortgage than anything else? How about whether or not I've paid my rent? That is not included in the credit score because initially they didn't have the information, and it wasn't included in the original models because there was no information. The credit bureaus have started to try to get that information, but they have it on so few of the loans that it's not as powerful as predictor as it could. But if you take a mortgage borrower who's we've done this exercise where we've looked at a mortgage borrower who's made 2 years of on-time payments and said, what is the probability of making the next 3 years? It's really, really high.
Yep.
That is something like 99.5%. But if you take a borrower who's missed one payment, his probability of default goes from like 0.5% to 5%. If he misses 2 payments, it goes to 20% over the next 3 years. And if he misses 3 or more, it's like 50%. So it just goes up exponentially. And you'd think that, with most people's rent payments not too dissimilar to what they are for their mortgage payments, you'd see the same pattern. So if you have a borrower who either doesn't have a credit score or who has a low credit score because he's a fairly new user of credit, but he has 2 years of on-time mortgage payments, that should be a great predictor, and we're not using it.
Yeah, one of the stunning things to me is in the presence of eviction moratoria, how people are still paying their rent. We just did a study of Los Angeles, and we basically found there were only 2 groups of people who were not paying their rent at the rate that they were before, and those are people who lost their jobs or people who got COVID. And everybody else, you had 95% on-time rent payment, which is sort of what the general on-time rent payment rate is. So yeah, I mean, the other thing is, people talk a lot about moral hazard in the mortgage business, and it's something I worried a lot about. And something that really changed my mind about it was the financial crisis. As we saw so many people, millions and millions of people, who were severely upside down on their houses, where even given the credit, hit on credit and so on, the rational thing for them to have done would have been to walk away. The really rational thing would have been to buy another house first and then walk away. And they didn't do it. We basically found, right? And I remember asking you to do this when we were in DC together, looking at people who were upside down on their houses and conditional on that if they were current. Were they any more likely to default the next period than people who were right side up? And they were, but by a minuscule amount. It's like, I mean, if the trigger happened, then they were going to do it and the others weren't. And so, I think we are seeing sort of on the business side of things, we do see moral hazard as an issue. But on the consumer side, it just doesn't seem like that big a deal to me.
And fortunately, that's actually one of the big lessons in my view that the policymakers have absorbed this time around. Because in sort of 2008, 2009, they're so concerned about moral hazard. Oh, we got to require a lot of documentation because we're worried about moral hazard. People are just going to take advantage. This time, it was forbearance, no questions asked. You had to attest to the fact that you had hardship, or could have hardship, but it was a pretty minimal. And in fact, you look at the low number of borrowers taking advantage of forbearance because people who can pay will, by and large, will pay. So, and to their credit, it was like, oh, we got to institute a forbearance policy. There wasn't we got to require the following 27 pieces of documentation first. I think that was one of the big, sort of in my mind, that was the biggest lesson learned from 2008.
No, it is really good that people learned it. So I want to finish with a slightly, it's a considerably different question from the line of questions I asked at this point. It's just that, so you've lived in New York City, the New York metropolitan area for a long time. And there are people who are writing off New York now, and we do see people, the vacancy rate in Manhattan residential vacancy rate has risen to levels probably not seen since the 70s. And so there's no doubt at the moment it's hurting. But longer run, are you bullish, bearish, or neutral on New York?
So I am actually bullish on housing, period, everywhere. I am less bullish on housing in New York than I am in many other places because I think the fact that people can work from home more, so you only have to come in 2 days a week or 3 days a week, means that at the margin you're prepared to move out of the city a little bit more quickly or not move back in as quickly. And in addition, sort of the people were already moving out of New York long before COVID-19. I think the changes in the tax law that went into effect at the end of 2017, with the lack of limits on the reduction of state and local taxes had a huge impact on high tax states. So that's,
Although, Laurie, I
I
have to tell you, Musa and Diop did a difference of difference regression on that. Now, we have only 1 year of data, but we had the 2018 IRS migration data. And we did difference of difference, and you can identify the effect of the state and local tax deduction because there's such variation depending on where. And we found nothing. We found no change in the trend. Now, there has been a trend about migration from New York from a long time, but we saw no acceleration in that trend.
Oh, interesting.
As a result of that law, but yeah, maybe I can present this at an ARC thing or something. But
I'd love to see that because I actually thought.
But my caveat is it was 1 year of data, so it does take a while for people to actually uproot themselves and so on.
Yeah.
But
I thought that the sort of composition of the exodus might have changed with more higher income taxpayers.
It's funny, in California in 2018, we actually saw the opposite. We saw high-income people move in and low-income people move out. And that's because the cost of housing is just so, that pushes people out. I have no doubt about that. And the other thing I find interesting about, talking about taxes is, did you even feel the slightest blip with the mortgage interest deduction was basically clawed back by about 90% with the 2017.
Oh, yeah.
Have you felt, we had a little earthquake here in Los Angeles on Friday night. That earthquake, I felt that a lot more than I felt any impact of the Tax Recovery and Jobs Act on house prices.
Oh, yeah, I didn't expect to see any. Sort of the thing about the mortgage interest deduction is that a lot of people with sort of low and medium incomes weren't itemizing before, and now of course none of them are itemizing, and some of the higher income people aren't itemizing either. But most of the people who, the biggest difference in the is actually so the SALT tax is far more impactful than the mortgage interest deduction, just in terms of kind of the dollars and cents.
Yeah.
But the people for whom the mortgage interest deduction was perhaps the most meaningful were those who make around $75,000 a year and would have deducted before and don't deduct now. But a huge percentage of them were going to be homeowners anyway, and their entire tax bill went down by and large as a result of this. So no, there was no impact, and I didn't actually expect to see one.
Okay, well, Laurie Goodman, thank you for spending some time with us. Always appreciate it.